Folks, you are not going to believe what the volatility index did this week. She sat there in the high teens the entire time, practically yawning at every headline that screamed crisis, while the rest of the world lost its mind over tariffs and wars and central bank dissents. The VIX refused to spike. She hovered right around 18, calm, collected, almost smug, as if she alone understood that most of what passed for breaking news had already been priced in weeks earlier. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Now listen, if you remember nothing else from this week, remember this. The market walked into a geopolitical minefield on Monday morning. Headlines everywhere warned of escalating trade wars, fresh tariffs on anyone doing business with Iran, renewed friction between Washington and Beijing, and a central bank that could not decide whether to cut or hike. Oil jumped hard on Middle East tensions. Gold sold off anyway. The dollar strengthened, and through it all, our conservative Iron Condor positions just kept collecting premium like nothing unusual was happening. That disconnect between what the pundits screamed and what the tape actually showed, that was the real story. The volatility index knew something the bears did not. She stayed contained. She stayed in contango. And that gave every disciplined trader who follows our rules the chance to harvest theta 5 days straight without a single hold signal. Here's the thing. Most analysts looked at those headlines and called for panic. But panics do not look like steady premium collection in a VIX that refuses to budge above 19. You and I know what really happened here. Smart money had already positioned for the noise. The tape had already digested the drama. And the volatility index spent the entire week proving it. She tested the 18 level. She held. She laughed at the noise. And by Friday, she had delivered one of the cleanest weeks for short premium strategies we have seen in months. Monday morning, the market woke up to a world that had changed over the weekend. The administration announced plans for a 25% tariff on any country still trading with Iran. CNBC told you this would ignite a full-blown trade war. The tape did something far more interesting. It barely flinched. The S&P 500 opened with a modest gap lower, but found buyers almost immediately. Meanwhile, crude oil climbed steadily toward the $100 level. That move in energy was the first signal that geopolitical tension in the Gulf was real. Yet the volatility index opened the week right around 18.5. She refused to spike. She simply sat there in contango as if to say the market had seen this movie before. You and I know what really happened. The tariff threat had been telegraphed for weeks. What the headlines sold as sudden escalation, the bond market had already priced weeks earlier. Treasury yields moved modestly higher early in the week. That told you real rates were not collapsing. Inflation expectations were not running away. The dollar firmed slightly. All of this should have created fear, but the volatility index would not cooperate. She stayed below her 5-day moving average. That single fact set the tone for everything that followed. By Tuesday, the narrative had shifted again. Reports emerged that the India-United States trade deal remained elusive. At the same time, stories circulated that China was watching both the Trump administration and the Supreme Court as it prepared its next moves in the ongoing trade friction. The mainstream financial media framed this as the resumption of all-out trade war. Here is what the tape actually showed. The S&P 500 stabilized. Crypto, which often leads risk appetite on Sunday night, and Monday actually held firm, with Bitcoin trading around 76,000 before pushing higher later. That quiet strength in digital assets was the first unexpected connection of the week. While equity headlines screamed danger, Bitcoin refused to roll over. It was almost as if institutional money was saying, "We have heard these tariff stories before, and we are not panicking yet." The volatility index on Tuesday still refused to break higher. She dipped slightly. She stayed calm. Contango deepened. That setup told every short premium trader that the regime remained favorable for our iron condor approach. Remember how our system works. Each day is independent. We place our conservative, balanced, or aggressive iron condor between 3:05 and 3:14 in the afternoon Central Time. The position expires the next market day. Cash settled. No assignment risk. No overnight stock exposure. Win or lose, the trade is over at the close. Full credit kept. If it expires, worthless. Defined loss if a leg is breached. No rolling from one day to the next. No carrying losers forward. Clean slate every single afternoon. The discipline mattered this week because the geopolitical noise kept coming. The Federal Reserve kept interest rates steady. Dissenters spoke out saying the next move could be either a cut or a hike. Inflation uncertainty was rising. CNBC framed this as confusion at the Fed. The bond market showed something different. Yields moved modestly higher. The 10-year note settled the week near 4.38% after trading as high as 4.42% midweek. That slight firming in yields told you the market was not convinced the Fed would ride to the rescue with immediate cuts. Real rates were not collapsing. And the volatility index noticed. She stayed contained. She stayed below 19 for most of the week. That single behavior protected every conservative iron condor we placed. Now ask yourself, when was the last time you saw a setup this clean? Headlines full of tariffs and central bank uncertainty, oil pushing toward fresh 3-week highs. Yet the volatility index refused to panic. She hovered. She whispered rather than screamed, and that whisper told us the math still favored premium collection. Our RSAI engine, which scans SKU VWAP and VIX momentum in under 300 milliseconds, kept delivering place signals every single day. 5 place days, 0 hold days. That pattern alone reveals how orderly the volatility surface remained despite the geopolitical chaos. The setup was almost perfect for our approach. Conservative tier targeting around 70 cents of credit with wider wings, outside the expected daily range. Balanced tier around $1.15. Aggressive tier around $1.60. All three remained live because the volatility index stayed below 20. Our 10% of account maximum risk rule stayed in force. No stop losses. Set and forget execution after the 3:10 p.m. Central Time window. The ALVH adaptive layered VIX hedge remained fully deployed across all regimes. That 4-4-2 structure of VIX calls, short, medium, and long term, continues to act as our second engine. It has historically cut drawdowns by 35 to 40% at an annual cost of only 1 to 2%. In a week like this where headlines scream danger, but the volatility index refused to confirm the threat, that hedge provided the sleep well, at night confidence every listener deserves. By the close of Tuesday, the central tension of the week had been established. Geopolitical risk was real. Trade friction was escalating. Central bankers were divided. Energy markets were reacting. But the volatility index, the true character of this story, had made her position clear. She was not impressed. She would not spike. She would stay in the high teens and let the noise wash over her. That decision by the volatility index set up everything that happened next. And what happened next was one of the more instructive twists we have seen in months. Wednesday changed everything. Or at least it should have. The United Arab Emirates announced it would quit OPEC effective next month. Headlines immediately linked the move to the ongoing Gulf energy crisis, rising tensions in the Strait of Hormuz, and the broader United States-Iran conflict. Oil, which had already been climbing, jumped sharply. It settled the day near $107 after trading as high as $106.88. That was the largest single-day move in crude in weeks. The mainstream financial media told you this signaled imminent supply disruptions and higher inflation. They painted a picture of energy markets in chaos. Here is what the tape actually showed. The S&P 500 did not collapse. It held its ground. The volatility index, which should have exploded on such news, barely budged. She climbed only modestly. She remained below 19. That refusal to panic was the second unexpected connection of the week. Oil was screaming geopolitical risk. The volatility index was whispering that the risk had already been discounted. You and I know what really happened. The market had been watching the Iran situation for weeks. The possibility of disruption in the Strait of Hormuz had been reflected in option pricing long before the UAE made its announcement. So when the news finally hit, the volatility index simply shrugged. She had already positioned for it. This is where it gets interesting. Gold, which many consider the ultimate safe haven in times of Middle East tension, actually sold off early in the week. It started Monday at $4,675.40. By Wednesday, it had fallen to $4,545.20. That move lower in gold, while oil soared and tariffs were being threatened, represents the third unexpected cross-asset connection. Normally, you would expect gold to rally on war risk and dollar strength. This time, gold looked at the strongest dollar in recent memory and said, "Not today." It ignored the traditional playbook. It sold off anyway. That told you something deeper was at work. Real rates were not falling fast enough to support a big safe haven bid. The dollar, which climbed from 98.48 to 98.92 by Wednesday, was exerting downward pressure on gold, and the volatility index noticed all of it. She refused to confirm the fear trade. By Thursday, the twist deepened. Reports emerged that Russia had emerged as an early winner from the Iran conflict. Moscow was calculating benefits from the Gulf situation. At the same time, stories circulated about 4 years of lessons from the Russia-Ukraine war. The mainstream framed this as escalating global instability. The bond market once again told a different story. Yields pulled back slightly from their Wednesday peak. The 10-year settled near 4.39%. That modest retreat suggested the inflation scare from higher oil was not yet convincing enough to keep yields elevated. The dollar gave back some ground, falling to 98.08, and gold found a bid climbing back to $4,614.70. The volatility index on Thursday remained the steadiest character in the drama. She held right around 18. Contango stayed intact. That stability allowed our RSI engine to keep delivering place signals. We placed again on Thursday. The conservative iron Condor went out with wings set well outside the expected daily range. The ALVH hedge continued to provide its quiet protection. Remember what that hedge really is. It is not a speculative bet on higher volatility. It is a layered structure designed to monetize VIX expansions while capping the damage to our short premium book. In back-tested periods, including the 2020 crash and the 2022 inflation bear market, it limited drawdowns by 35 to 40%. This week, it simply sat there doing its job while the world argued about wars and tariffs. Here's what I find fascinating. The week delivered 5 straight place signals. Not a single hold. That pattern is rare. It tells you the volatility regime stayed remarkably consistent despite the geopolitical noise. Our theta time shift protocol, which rolls, threatened positions forward when the expected daily range exceeds 0.94%, or when the volatility index clears 16, never had to trigger. The trade simply expired worthless day after day. Full credit kept, no drama. That is the power of defined risk structures in chaotic times. The Iron Condor does not care about the headline. It cares about where the market finishes relative to our strikes at expiration. And this week, the market cooperated 5 days in a row. The twist of the week was this: everything that should have caused volatility to explode did not. The tariff announcements, the OPEC exit, the Iran conflict developments, the Fed dissent. The market absorbed them all. The volatility index refused to play the role the pundits assigned her. She stayed calm. She stayed contained. She let the noise pass. And in doing so, she handed patient, disciplined traders one of the more profitable weeks in recent memory. But the real payoff was still coming on Friday. And what happened then tied all these threads together in a way that revealed the deeper truth about this market. Friday brought the resolution. The market had absorbed every geopolitical shock the week could throw at it. Oil, which had peaked near $107, settled the week at $101.94. Still higher on the week, but no longer in full panic mode. Gold recovered some of its earlier losses, closing at $4,629.90. The dollar eased slightly to 98.21. Bitcoin pushed through $78,000, showing real strength. Ethereum followed, closing near 2,300. The S&P 500, which had been range-bound most of the week, finished with modest gains. The entire equity complex looked as if it had simply decided the noise was not worth the fear. The volatility index on Friday closed right where she had spent most of the week, in the high teens, calm, contained, still in contango. That final confirmation that fear had been overstated allowed every iron condor we placed to expire worthless. 5 placements, 5 full credits kept, not a single breach, not a single defined loss. That 100% win rate for the week was not luck. It was the direct result of the regime the volatility index had maintained. She never cleared 20. She never broke the contango. She gave our RSAI engine clean signals every afternoon at 3:10 Central Time. The expected daily range stayed manageable. Our wings stayed safely outside the projected move. Theta did the rest. Now listen carefully, because this is where the story gets personal. If you were sitting at your desk any afternoon this week, placing those iron condors with us, you felt the difference. The conservative tier, with its wider wings and 70-cent credit target, worked perfectly in this environment. The balanced tier delivered its $1.15 target without drama. Even the aggressive tier, which we keep available when conditions allow, stayed live, because the volatility index never forced us into risk scaling that would block it. 10% of account risk per trade. No stop losses. Set and forget. That is not a slogan. That is a discipline that survived this week's geopolitical chaos without a scratch. The resolution on Friday also highlighted the power of our ALVH hedge, even when it was not needed. That layered VIX call structure, 442, across short, medium, and long-dated contracts, sat quietly in the background. It cost us 1 to 2% annually. It delivered zero drama this week, but its presence meant that even if one of those days had turned against us, the hedge would have offset 35 to 40% of the drawdown. That is the beauty of the system. It does not require perfect timing. It requires consistency. The temporal theta martingale, which rolls, threatened trades forward on our mechanical triggers and then rolls them back when conditions normalize, never had to fire. The market simply stayed inside our ranges. You and I both know what the mainstream missed. They spent the week telling you the trade war was resuming, that the Iran conflict was reshaping energy markets, that the Fed was divided and inflation was coming back. They framed every development as potentially catastrophic. The tape did the opposite. It digested the news. It repriced risk without panic. It allowed the volatility index to remain the calm center of the storm. That is what conservative truth-seeking looks like. Question the narrative. Trust the tape. Follow the money. The money this week flowed toward stability. It rewarded patience. It rewarded defined risk. It rewarded the iron Condor trader who showed up every day at 3:10 Central Time and let math do what headlines could not. The week resolved exactly as the volatility index had been signaling from the first hour of Monday. Calmly, orderly, profitably for those who stayed disciplined. 5 place signals, 5 wins, capital preserved, premium harvested, drawdown avoided. That is not a random outcome. That is the product of a system built for exactly this kind of environment. Geopolitical noise, central bank uncertainty, energy shocks, trade friction, all of it. The system does not predict. It protects, it collects, it compounds. And this week it did all three beautifully. Step back now and look at the entire canvas. This week was never really about any single headline. It was about how capital moved through a world full of conflicting signals. The tariff announcements on Iran and the renewed friction with China should have sent everything higher in volatility. The tape showed those risks had been largely anticipated. The UAE exit from OPEC should have created an energy crisis panic. Oil rose, but the broader equity market absorbed the move without breaking. The Fed's steady rates and dissenting voices should have created confusion. Yields rose modestly, then settled. The volatility index refused to validate any of the fear. That is the bigger picture. Three distinct, unexpected connections tied the week together. First, the disconnect between oil and the volatility index. Crude climbed from $96.37 on Monday all the way to $106.88 by Wednesday, before settling back near 102. That was real geopolitical pricing. Yet the volatility index barely moved. She treated the energy shock as contained. That told you the market believed the disruption would be temporary. It also told you our short premium positioning remained intact, because implied volatility never exploded the way realized volatility might have suggested. Second, the curious behavior of gold versus the dollar. The dollar index climbed from 98.48 to 98.92 midweek before easing back to 98.21. Normally that strength would crush gold. Gold did fall early in the week from 4,675 to 4,545 before recovering to 4,630. But the fact that it did not collapse further while the dollar firmed and oil rose suggests safe haven flows were selective. Investors were buying the dollar for its yield and its haven status, but they were not rushing into gold with the same conviction. That divergence revealed something the mainstream missed. Real rates were the dominant driver, not pure fear. The volatility index saw it. She stayed low. She kept contango alive. She protected every iron Condor wing we sold. Third, and perhaps most telling, was the behavior of Bitcoin and Ethereum relative to the equity market. Bitcoin traded as low as 75,776 on Wednesday, then pushed steadily higher, closing the week near 78,487. Ethereum followed a similar path, bottoming near 2,253 before closing near 2,318. While equity headlines warned of trade war escalation and central bank confusion, crypto refused to roll over. In fact, it led the recovery. That quiet strength in digital assets, while traditional safe havens like gold were mixed, was the clearest signal that institutional risk appetite had not been destroyed. The volatility index confirmed it by refusing to spike. The entire risk complex was saying the same thing in different languages. The noise is real, but the damage is contained. Now pull back even further. The euro-dollar pair barely moved all week. It traded between 1.169 and 1.173. That stability in the world's second most important currency pair told you global capital was not rushing for the exits. It was rotating, it was repositioning, but it was not panicking. The 10-year yield, which peaked at 4.42% before settling at 4.38%, showed the bond market was watching inflation risks from higher oil, but was not yet convinced they would persist. All of these cross-asset signals converged on one conclusion. The volatility regime remained favorable for disciplined premium selling. This is what the bigger picture reveals. Geopolitical events matter. They move capital. They create volatility, but they do not always create the kind of volatility that destroys short premium strategies. The Iran-related tensions, the tariff threats, the OPEC shakeup, the Fed dissent, all of it was absorbed. The volatility index, with her moods and her wisdom, acted as the ultimate filter. She filtered out the noise. She highlighted the signal. She rewarded those who trusted math over narrative. She protected those who used defined risk structures like our iron condors rather than trying to predict the next headline. VixShield exists for exactly these moments, when the world feels chaotic, when pundits scream crisis, when every asset class seems to be sending conflicting messages. Our system does not require you to know which narrative will win. It requires you to follow the rules. Place at 310, size at 10%. Use the RSAI for strike selection. Keep the ALVH hedge live. Let theta do its work. Roll only when our mechanical triggers fire. Never add capital. Never chase losses. That discipline turned this week's geopolitical chaos into 5 straight days of harvested premium. That is capital preservation in action. That is income generation without speculation. That is what conservative stewardship looks like in uncertain times. So let us talk about the scorecard in the only way that matters. Not as a table of cold statistics, but as the logical conclusion of the story we just lived through. This week gave us 5 opportunities to place, 5 opportunities to collect, 0 opportunities to hold. That 100% place rate in a week full of tariffs, wars, and central bank uncertainty is remarkable. It reveals how orderly the volatility surface remained. Our RSAI engine delivered clean place signals every single day. The expected daily range stayed inside levels that allowed our wings to remain safe. The conservative tier performed exactly as designed. Wider strikes, steady credit, high probability of expiring worthless. The balanced and aggressive tiers stayed available, but the conservative approach proved once again why it remains the foundation for most accounts. The discipline lesson from this week is crystal clear. When the volatility index refuses to confirm the fear in the headlines, that is when our edge is greatest. She stayed below her 5-day moving average most of the week. She stayed in contango. She never forced us into full risk scaling that would have blocked the aggressive tier. That consistency let us harvest premium without ever having to deploy the temporal theta martingale. No threatened trades, no forward rolls, no need to wait for VWLP pullbacks to roll back. Just clean expirations day after day. Full credit kept. Capital intact. That is the power of a rules-based system that does not react to headlines. It reacts to price skew momentum and expected range. You and I both know most traders would have looked at the Iran developments, the tariff announcements, the OPEC exit, and the Fed dissent, and done one of 2 things. They would have either sat on the sidelines in cash earning nothing, or they would have tried to predict the next move and likely lost. Our system did neither. It stayed deployed. It stayed disciplined. It stayed mechanical. 10% of account risk per trade. No stop losses. Set and forget after the 310 window. The ALVH hedge remained live as insurance, even though it was not called upon. That quiet protection is what allows us to sleep well at night when the rest of the world is losing its mind. The scorecard this week was simple: 5 wins, 0 losses, premium collected, experience gained. The win rate over the recent period remains well above our 85% gate. The maximum drawdown stays tightly controlled. The Sortino ratio and theta to Vega relationship both stay healthy. These are the metrics that matter. These are the metrics that should be soul-bound to any trader who claims mastery. Not some fancy token, not a status badge. Real, verifiable execution over time. 100 flawless place signals under strict risk rules. That is how proficiency is earned. That is how stewardship is proven. And honestly, this was one of those weeks where everything lined up. The geopolitical noise created the appearance of chaos. The volatility index revealed the underlying order. Our system simply did what it was built to do: protect capital first, harvest theta second, compound patiently over time. No predictions, no hero trades, just consistent execution in a world that rewards consistency far more than brilliance. That is the real scorecard, not the daily P&L. The preservation of discipline in the face of distraction. The willingness to trust the math when the narrative screams otherwise. This week, the math won. Decisively. Tomorrow in our Sunday forecast, I will walk you through exactly what I am watching Monday morning: the economic calendar, the volatility term structure, the latest readings on expected daily range, and precisely how our Iron Condor positioning stands heading into the new week. We will examine whether the contango we saw this week persists, or whether the geopolitical developments finally force the volatility index to wake up. You will not want to miss it. The setup for next week is already forming, and the volatility index is sending signals that only those who watch her closely will catch. And be sure to listen for any breaking news from Miss Vicky. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VixShield market summaries, proprietary signals, and private RSS feed. Visit VixShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. And now you know what the tape was really saying this week.